Hi everyone, welcome to Lighthouse Financial Planning's fourth quarter client webinar. My name is Jeanette Salmon and I'll be monitoring the webinar this afternoon. Our presenters today will be Jim Johnson and Debbie Gross, and Jim will be talking about the economy and the market outlook, the election is over, what now, and the fiscal cliff and other scary things. Following Jim, Debbie will talk about financial planning topic, year-end tax planning, what can you do now? And before Jim gets started, I'd like to go over a few housekeeping items. On the right-hand side of your screen, you'll see the Go To Webinar window. On the left side of that window, you'll see an orange arrow. By clicking on that arrow, you can either minimize or maximize that screen as you desire. And also for your privacy, I just want to let everyone know that you will be muted during the webinar. We'll be recording the webinar and expect to have it uploaded to our website within a couple of weeks. So you're welcome to re-listen and share the information from today's session. And with that said, I'll hand it over to Jim to get started.
Thank you, Jeanette. Welcome, everyone. Hope you had a great Thanksgiving weekend, and we're all looking forward to a wonderful holiday season. So, what I'm going to talk about today is, now that the election's over, what now, so we'll look at what could happen, what we think might happen. We're going to break our rule and look at our crystal ball a little bit. We'll also take a look at how investments have reacted to other crises. I wanted to let you know today, too, I've also inserted a number of quotes today that seem to be relevant. So from Theodore Roosevelt, it's difficult to make our material condition better by the best laws, but it's easy enough to run it by bad laws. So my idea here, obviously, is that the government probably won't make things much better, but it sure could screw it up if they don't do right. So let's take a look at the fiscal cliff. And on January 1st, a slew of new tax law changes and spending cuts are poised to take place. The Bush-era tax cuts will expire. The alternative minimum tax will snare more taxpayers. The payroll tax holiday will sunset. And the new investment surtax to pay for the Affordable Care Act, otherwise known as Obamacare, will take effect. On the spending side, defense, discretionary spending and entitlement cuts are on deck, and unemployment will be scaled back. All in all, these cuts and tax increases could amount to, by some estimates, to more than $700 billion, and could shrink the economy by as much as 4.5% of GDP. Now, during Debbie's section, she'll be talking more about some of the proposed tax law changes, some of the things we think that you'll be looking at, and things we think that might not take place. But anyway, that's what, if everything, that's why they call it the fiscal cliff, because a 4.5% hit to GDP looks like this. So in the third quarter of 2012, our most recent number, the U.S. economy grew by 2%. If the fiscal cliff hits, all aspects of it hit, there'll be a decline in GDP of 4.5%. Do the math, and the net effect is a minus 2% of GDP. That's the definition of a recession. So how do we respond? Well, first, another quick quote for you. And the thought here is to suggest, don't get caught up in all the political and media madness about all this. The political rhetoric will be hot. Count on that, but don't buy into it. Behind the scenes, there's a lot going on we don't know about. So let's talk about what's going on in the U.S. economy today. So one of the facts is that the European fiscal crisis is way different from what the U.S. faces. Debtor nations like Greece and Spain do not fully control their economies because they're lashed to the German austerity policies through a common currency, the euro. That means that those countries do not have their own currencies to devalue, which could spur exports. Nor do they have a central bank like the U.S. Federal Reserve, which could provide liquidity for their banking systems. The United States does have long-term fiscal challenges and years of unsustainable trillion-dollar budget deficits that need to be dealt with. But our problems are largely due to the fact that we're still groping our way out of the worst economic downturn since the Great Depression. So slow but persistent economic growth will reduce many of our budgetary problems. For example, global confidence in the U.S. economy is reflected in the near record low interest rates available on 10-year and 30-year Treasury bonds. Interest rates are driven by demand. So the low interest rates mean that investors around the world are willing to tie up their money for 30 years in Treasuries for the paltry interest rate of 2.8%. So what if Congress misses the December 31st deadline to extend the Bush tax cuts? It's kind of part of a shell game. The Treasury Department has wide discretion in the pace in which it instructs employers to adjust their income tax withholding rates. Chances are Treasury will do nothing in January to change rates for anybody earning less than $250,000 a month, or $250,000 a year, which is most of us. Meaning a temporary increase for those wage earners would be a fiscal distraction rather than a real-world wallet crunch. And when Congress and the President do get around to the inevitable tax deal, the new lower rates will be retroactive to January 1st. Make no mistake, some people will see their taxes increase. For the past 2 years, most people in America have benefited from a 2% reduction in payroll taxes, a cut designed to stimulate the economy in a period of high unemployment. But the payroll tax cut was always supposed to be temporary rather than a permanent rate cut. While nothing is certain, chances are the payroll taxes will revert to their normal level next year. That was the rough number in the 2010 Simpson-Bowles deficit reduction plan, and it carried over to Obama's abortive 2011 negotiations with Republican House Speaker John Boehner. So $4 trillion is not any magic number. It's just the one that they've been throwing around. Everyone wants credit for tackling the deficit, but nobody wants to be blamed. As recounted in Bob Woodward's book, The Price of Politics, a dramatic moment in the 2011 Obama-Boehner negotiations came when the two men battled over boosting the age to qualify for Medicare. Boehner wanted the age change to take place in 2017, while Obama wanted to hold out until 2022. That is what Washington is in a nutshell. Both men wanted to postpone the pain until they retired from office. They wanted to bask in the glory of reaching a grand bargain on the deficit with all the complications reserved for a future president and House Speaker. So, what might happen? I'm sorry? Yes. There we go. So what might actually happen? Inaction due to political gridlock is the first scenario. Could happen, but probably not. We think they are going to cut a deal. This is one of those few times when we will look in our crystal ball and tell you what we see. The second scenario is a short-term, smaller deal to kick the can down the road. We think that's probably what most likely will happen. And the third scenario is the grand bargain, possible but not likely. So the least likely scenario, we think, is actually going off the cliff. Now, while they may not get along publicly, what's happening that we don't see? Time for another quote. This is from Harry Truman. John Adams and Thomas Jefferson were political enemies, but they became fast friends. When they passed away on the same day, the last words of one of them was, quote, "The country is safe, Jefferson lives," unquote. The last words of the other was, quote, "John Adams will see that things go forward," unquote. That gives us hope that they just might find things, and we will get through this. So how have the markets responded to past crises? This slide shows the performance of a balanced investment strategy of 60% stocks and 40% bonds, which is where most of you are, but it's a good model. Each crisis has labeled by the year and month in which it occurred or peaked. The subsequent 1 year and 3 year, 1, 3, and 5 year annualized returns start from the first day of the month following the crisis. Although global investment strategy would have suffered losses immediately following most events, financial markets recovered over time as indicated by the positive 3- and 5-year cumulative returns. Negative events such as these may tempt investors to flee the financial markets, but diversification and long-term perspective can help investors apply the dividends to ride out the storm. By the way, how are we doing today? This slide is from Russell Investments that they publish an update of quarterly. This is the most recent data. The point of the slide is this. Look at the shaded blue part of each line. That's the typical range for that particular statistic. In every case, where we are today is at some point in the typical range. So things aren't horrible right now. While they may not be great, they're not horrible. Right now, things are within acceptable norms, believe it or not. So what do? Control what you can control, and don't worry about the rest. What can you control? Your goals. You can manage risk, which is what you hired us to do for you. Choose the risks that actually paid off, which we help with. We pay attention to expenses, and we support you in being disciplined. So have some goals. What's the point? Why are you investing? For retirement? To accumulate money for retirement? To support you in your retirement after you are retired? To build family wealth? For your education or for others in your family, children, grandchildren, another home, whatever it is? Be clear about why you're investing. And the second thing we can do is manage risk. And I want to divide risks into two categories. And some of you may have heard this from us before. Yeah, we're a bit of a broken record about these things because that's what matters. So we're going to divide risk into two categories, unsystematic risk and systematic risk. Unsystematic risk are those risks that are specific to that particular investment, a company, a stock, piece of real estate, etc. What's the risk of investing in that company versus another, that piece of real estate versus another? And then there's systematic risk. Those relate to the whole market, for example, stock market risk or real estate market risk. So we can manage unsystematic risk by diversification. You buy a bunch of them. If you own 500 stocks in a mutual fund and one of them has problems, it may have a small effect on the overall performance of the fund, but you're not really slapped hard. If you own a portfolio of real estate properties and one of them has troubles, it doesn't drag them all down. So that's how you reduce risk. And there's actually studies that have done it. So it's at a certain point in diversification, you've essentially eliminated unsystematic risk for all practical purposes. The other risk that we're going to talk about is systematic risk, which are those that affect that particular market. And the way you reduce that risk is through asset allocation. You place your investments in different kinds of investments that tend to act differently in different environments. For example, U.S. stocks and foreign stocks, real estate, bonds, that sort of thing. What else can you control? You can choose those risks that actually pay off. You know, the risk-reward payoff. You pick those risks that actually pay off with some reward. In the stock market, research by Fama and French, Gene Fama and Ken French, indicate that 3 factors are where investors are best paid for taking risk. That's by being in the stock market versus in bond markets or CDs. By the size of the investment, smaller companies tend to outperform large companies, and value versus growth. Value companies tend to outperform growth companies. The size and price effect, and where you see a BTM that's book to market, that's a way of measuring value, affects both in U.S. and global markets. This graph illustrates the higher expected returns offered by small caps and value stocks in U.S. and non-U.S. and emerging markets. So if you look at the graphs for a minute, let's take a look at the graphs. The first graph with the dark blue is large stocks, value versus growth. You can see that value has done better than growth. The second graph is small, with the light blue, is small companies versus large companies. You see the same thing, but the numbers are higher than they were for the small. So if we look at this graph, the first big blue line says that this is the market premium, that is from 1927 to 2011, a long period of time. Stocks earned on average almost 8% more than government bonds. The size premium is the next one. Excuse me. And that showed that small stocks on average earned 3.6% more than large stocks. The third bar shows that value stocks tended to earn 4.7% more than growth stocks did. Continuing at what you control is costs and expenses. Trading costs. We've talked to you all about trading costs. We either use no transaction-free funds, or we use no-load funds with low trading costs by using Fidelity or TD Ameritrade or one of our other custodians. We look at the management fees of the mutual funds to keep them as low as we can, and we make sure that the companies that are in the mutual funds are paying attention to the bid-ask spreads, that is the difference between the buy and sell price, of the stock or bond. And then we want to talk about the other thing you control is being disciplined. Stick to your strategy. There's no academic evidence whatsoever that anyone at any time can consistently beat the market by timing. The challenge is if you get out, when you get back in. A recent study shows why. This is from October of 1990 through September of 2010. And it shows that if you were fully invested for those 5,040 stock market trading days, you'd earn just over 9%. If you missed the best 10 days, you would have gotten a little better. You'd have got about 60% of that. I'm thinking the math works out to be about 5.3%, about 5 1/3. If you missed the best 20 days, just under 3%. And if you missed the best 30 days, if you were in the market 5,010 days, and you missed the best 30, you would have got less than 1%. Another look at it is for a longer period from 1970 through 2011. In this particular slide, you can see that the stock market, the S&P 500 earned 9.8%. If you missed the best one day, you can see what even then you didn't do as well. If you missed the best 5 days, etc. So trying to forecast which days or weeks will be good or bad is a guessing game that can prove costly to investors. The point is no one knows when the next big day will come, but you sure don't want to miss it. So in review, what can you control? Research shows that investors earn less than what they could in this study by Zweig and Morningstar, looking from 89 to 94. The average mutual fund earned 12.5%, while the average investor earned 2.2%. In a Dalbar study that went from 20 years ending 2009, the average mutual fund earned 8.2%, but the average equity investor only earned 3.17%. Why is that? Well, people waited until it was going up, had gone up, was already up before they bought, and then when it was going down, had already gone down, they got scared and sold. So being disciplined and sticking to your strategy is the way you make money in the market, not by buying when it's going up and selling when it's going down. So in review, let's talk about what you can control and what you don't need to worry about. Have goals. We manage your risks. Choose investments that pay off. Have a typo there. Expenses matter. And be disciplined. Control what you can and don't worry about the rest. Don't fall prey to the talking heads, the political people in the media. Keep a cool head. Okay, I'm going to end up with a couple of my favorite quotes. The first one is from Sir John Templeton, one of the legendary investors of all time. To buy when others are despondently selling and to sell when others are greedily buying requires the greatest fortitude and pays the greatest reward. Next one is from Warren Buffett. Look at market fluctuations as your friend rather than your enemy. Profit from folly rather than participating in it. And my favorite of all times, again from John Templeton, the four most dangerous words in the world are investing is it's different this time. So that concludes my part of the presentation.